Hi everyone, welcome to our Commercial Masterclass podcast. Today's episode is Maximising Returns on Investments in Commercial Property. I'm your host, Jocelyn, Commercial Lending Director at XIN Mortgage, and today we're diving into the strategies smart investors use to unlock greater returns from their commercial property investments. This episode is packed with practical insights from the experts who help make it happen. Joining me today are Patrick Chu, Founder and Director of TDQS, and Molly Lim, Founder and Director of Above Advisory. Together, we'll break down how finance, tax, and depreciation strategies work hand in hand to improve cash flow, boost serviceability, and optimize tax outcomes for commercial investors. So without further ado, let's jump straight in.
Thank you, Jocelyn, for having me today. So firstly, I'll ask you a few questions regarding property commercial financing. So a lot of our clients ask, what do commercial property financing involve and how do you help clients secure their loan?
As a commercial finance broker, we help source different options for clients when it comes to commercial property purchase, and we help them negotiate terms and structure loans that align with their strategies.
So Jocelyn, how does property valuation and potential rental income could impact a client's borrowing capacity?
Based on the property valuation and rental income, we will know how much the property actually values at, and also it will state how much is the rental income. And the lenders assess a client's borrowing capacity based on the rental income against their loan repayments. So the higher the rental income, the higher the property value, means that the more the clients can borrow.
And what are the key considerations in one purchasing an asset which is industrial versus office or retail assets?
The lender's appetite may vary, so for industrial property, because of their low vacancy rate, it means that it often attracts a higher LVR. But as for office and retail property, it has a higher vacancy rates in the current environment. It means that the LVR may not be as high.
Hey Jocelyn, as a QS myself, how early should an investor involve the QS, the quantity surveyors, and accountant during the acquisition stage?
I would suggest a client to come to professionals like yourself and Molly as early as possible, ideally before purchase, because a depreciation specialist can forecast depreciation based on the asset, and the accountant can model cash flow to make financing more strategic.
What are common finance mistakes you see investors make? And how can working with a tax accountant and quantity surveyors expert help?
So the common mistakes are borrowing under the wrong structure and underestimating the actual outgoings of the property. So working with professionals like yourself and Molly, the tax accountant and depreciation specialist, can review the hidden deductions and structure ownership for tax efficiency. So Patrick, what is tax depreciation and why is it important for commercial property investors?
Tax depreciation allows you to claim a deduction for decline in value of your buildings and assets. It's crucial because it helps the property investor to reduce their taxable income, putting more money back into their pocket. And at the same time, it also helps them to improve the cash flow and return of investment.
So how does the tax depreciation schedule impact a client's borrowing capacity and their strategy?
Tax depreciation boosts your property's net cash flow by reducing your taxable income without affecting your balance in your bank. Lender often look at your net income when assessing your serviceability. So when depreciation increases your after-tax cash flow, you appear more financially capable, which can enhance your borrowing power. It's like unlocking extra serviceability without increasing your rent.
So when should a depreciation schedule be ordered? Before or after purchase?
Ideally, you should have it organized before your purchase, because a quantity surveyor can provide a depreciation estimate to help you model post-tax cash flow and improve your serviceability and support the financial approval. But if you have already purchased the property, it's never too late. We can backdate the claims, liaise with your accountants to maximize deductions from settlement onwards.
So as a quantity surveyor at TDQS, what are the most recent tax incentives that the investor can achieve when purchasing the commercial property investments?
I'm glad you brought this up because a lot of investors overlook this tax incentive given by the government because they're not aware of it and it's not going to be appear in your standard QS report. Specifically in the financial year end 2025, instant asset write-off eligibility ending on the 30th of June 2025. and this will be the last year we can claim 20,000 individually or each of the assets, and instead of writing it off over a period of time.
So Patrick, what is the biggest myth about tax depreciation in commercial property?
Unlike residential properties, there's no restrictions on claiming depreciation on second-hand commercial properties. As long as there is qualifying capital works, Division 43, and plant equipment, Division 40, owner can claim depreciation deductions even the properties are built decades ago.
So Molly, how do you work with commercial property investors to structure their borrowing ownership efficiently?
So we always work with mortgage broker like yourself and quantity surveyors when structuring the commercial loans for our clients. So when structuring the commercial property investments, we look at what type of structure works for them. So whether it could be under their individual structure, whether it's a trust structure or self-managed super fund structure to be more efficient. So Patrick, what are the main tax deductions that clients can miss out on if they don't get or go through a quantity surveyor to get the tax depreciation report?
Typically, easily overlooked would be your scrapping deductions. Scrapping deductions, it's the assets that are no longer in the building. For an example, the tenants may have moved out and new tenants come on board, they redo the fit up. So all the assets that the landlords has been claiming no longer in the building, they should be getting a new QS report and get the deduction straight away instead of claiming them over the period of time, over the 15 years periods. Another part of the deduction would be incentive. Often encouraging tenants to come on board, you give incentive to tenants and to spend on the fit out of the offices, and those are the deductions the landlord can claim. So they need to seek advice from a QS to get a quantity surveyor's report, we call it tax depreciation report, that able to mirror all the deductions of the money that is spent on the incentive.
Molly, how do finance structures impact annual tax planning?
Good question. So every financial year around April, May and June, we organize annual tax planning session with our client. So in this session, if a client had property investment portfolios, we review and see and ask them when was the last time they have reviewed their loan structure, or even if they already have a tax depreciation report on file. So that will give a really good insight about whether their loan structure is quite efficient and whether it's still being in line with their personal goals and objectives. Yeah.
As a quantity surveyors, myself, we always strive the best for our clients, for the best outcome. I just wonder, how do you collaborate with quantity surveyors, professions, and the mortgage broker, and for the best of their client outcome?
We assist our clients pre-purchase and post-purchase, and one during the settlement period, we sort of work with professionals like yourself, Jocelyn, and Patrick, in order for knowing what's the serviceability aligns with the client, or in terms of the property quantity surveying and depreciation report, if they're getting done, and even if they're getting done, whether they're getting done correctly and properly, in order to making sure that the quantity surveying report or depreciation schedule that they receive is to be in line and compliant with ATO. What's the point of getting the quantity surveying report when ATO could come back to the client one day and saying that they're not going to agree with all the depreciation put out on the schedule, right?
Absolutely. We've seen so many examples nowadays that you're getting a quantity surveying report, giving you some deductions, and because of the complications of the tax rules, no one really understands what value are they getting, whether they're getting the right deductions. With 28 years experience looking at the same report and working in the same industry, I can tell that there's a big gap in the market whereby a quantity surveyor specializing in residential depreciation. They're now doing a lot more commercial property. There's a huge gap because in commercial property, we're talking about 8,000 depreciating assets, not 20, 50. So there's a huge gap in terms of the experience. So if you want to do commercial depreciation, look for someone who is reputable, someone who has experience in the commercial space. Our final questions for Molly: what is the common mistakes that the property investor made in the tax return?
So there are a few things that property investors could easily overstate in their tax returns for property investors. So one of the things is if they have recently refinanced a property and a portion of that they've started using for personal benefit or personal use, now the whole loan is not tax deductible anymore. So instead of the whole loan being tax deductible initially, now a portion of it start to become a personal use. ATO is becoming very strict in data matching all the property deductions against the rental income because, over so many years, people make mistakes lodging in the tax return. So it is very careful to make sure that you are not overstating and also to check that we're also not missing out on any deductions that you're eligible for. So Jocelyn, how is tax depreciation treated when you're assessing a client borrowing capacity?
Calculate a client's borrowing capacity. A lot of people don't know that we look at the EBITDA, which is the earning before interest, tax, and depreciation. So we can actually add the depreciation expenses back into the net profit, which increases the client's borrowing capacity. And that wraps up this episode of Commercial Masterclass. A huge thank you to Patrick and Molly for sharing their valuable insights and practical tips. If there's one key takeaway from today, it is this: your finance, depreciation, and tax strategy should never exist in isolation. The best outcomes happen when your broker, depreciation specialist, and tax advisor work together from day one. Thanks for tuning in. If you enjoyed this episode, be sure to follow, share, and stay connected for more expert insights coming your way soon. Until next time, take care and happy investing.
Yeah.